Silver volatility is exploding right now. Prices are swinging wildly as global tensions rise. Investors are confused, traders are nervous, and markets are trying to figure out what comes next. But here's the real question. Is silver about to crash? Or is this the early stage of a massive breakout? Because behind the daily price swings, something much bigger may be unfolding. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. War risks are rising, oil prices are volatile, inflation pressures are returning, and central banks around the world are quietly buying more gold than at any time in decades. When those forces collide, precious metals markets rarely stay calm. Silver is often the most volatile asset in the entire commodity space, and right now that volatility is sending a very important signal. So in this video, we're going to break down why silver volatility is suddenly spiking, how geopolitical tensions are impacting the market, and what gold, oil, and the US dollar are telling us why silver moves more violently than gold. And most importantly, what investors should watch next. Because what all is happening right now in the silver market could shape the next major move in commodities. And the story is much bigger than a few daily price swings. The sudden spike in silver volatility. Let's start with what investors are seeing right now. Silver prices have been moving aggressively, sometimes swinging several percent in a single day. One moment silver rallies sharply, the next moment it pulls back just as quickly. To someone watching casually, this can look chaotic, but markets are rarely random. Volatility spikes usually happen when the market is trying to reprice risk very quickly. And right now, the global economy is facing several major uncertainties all at once. Geopolitical tensions are rising in multiple regions. Energy markets are unstable. Global trade routes are facing potential disruptions. And central banks are struggling to balance inflation and economic growth. When those forces collide, the financial system begins to adjust, and silver often becomes one of the most reactive assets, because silver sits at a unique intersection between industrial demand and monetary demand. Silver is both an industrial metal and a monetary asset. Unlike gold, silver plays two major roles in the global economy. First, it's a precious metal that investors buy during uncertainty, but second, it's also a critical industrial material used in modern technology. Silver is used in solar panels, electronics, electric vehicles, medical equipment, semiconductor manufacturing. In fact, according to the Silver Institute, global industrial demand for silver has been hitting record levels in recent years. And that demand is being driven by major technological trends: the energy transition, renewable power, electric vehicles, and expanding electronics manufacturing. All of those industries require large amounts of silver. So when the global economy changes direction, silver reacts. Why geopolitical tensions are affecting silver. Now let's bring geopolitics into the picture. When global tensions rise, several things tend to happen at once. Energy prices often move higher. Trade routes become uncertain. Investors begin seeking safe assets. And governments increase defense spending and infrastructure investment. Each of these factors can influence commodity markets. For example, rising oil prices increase inflation pressure across the economy. And inflation tends to push investors toward hard assets like gold and silver. Meanwhile, geopolitical uncertainty can weaken confidence in financial markets. During these periods, precious metals often become a hedge against instability. But silver reacts more violently than gold. Why? Because silver's market is smaller and more sensitive to changes in demand. Silver ES market is much smaller than gold S here. As a fact that many investors Don T realize, the global gold market is enormous, but the silver market is relatively small. That means even modest changes in investment demand can move prices dramatically. If large funds suddenly allocate capital toward precious metals, gold may move steadily. But silver can surge rapidly, and the same dynamic works in reverse. When investors sell precious metals during risk-off periods, silver often falls faster. This is why silver is sometimes called gold on steroids. It amplifies the same macroeconomic forces, but with bigger price swings. Now, here's something interesting. Silver volatility doesn't just reflect fear. Sometimes it reflects opportunity. Because historically, some of the biggest bull markets in silver began with periods of extreme volatility. When markets are calm, large price movements are unlikely. But when volatility rises, it often signals that something significant is changing beneath the surface. And right now, several forces are converging at once. The oil factor energy markets are one of the biggest drivers of global inflation. When oil prices rise sharply, production costs increase across nearly every industry. Transportation becomes more expensive. Manufacturing costs climb, and consumer prices often follow. Recently, oil markets have been reacting to geopolitical developments and supply uncertainties. The global oil benchmark Brent crude has been experiencing periods of heightened volatility. If energy prices continue rising, inflation pressures could return. And historically, inflation tends to support precious metals prices because metals like gold and silver are often seen as stores of value when currencies lose purchasing power. The role of the U.S. dollar. Another major factor influencing silver prices is the strength of the U.S. dollar. Most global commodities are priced in dollars. When the dollar strengthens, commodities often face downward pressure. When the dollar weakens, commodity prices frequently rise. The dollar's value is heavily influenced by interest rates and economic policy. The Federal Reserve plays a crucial role in this dynamic. If the Fed raises interest rates, the dollar may strengthen, but if the Fed signals future rate cuts, the dollar can weaken. And a weaker dollar tends to benefit precious metals. Right now, markets are constantly trying to anticipate the Fed's next move. That uncertainty alone can create volatility in silver. Silver versus gold. Why silver moves more. At this point, you might be wondering, if both metals respond to similar macro forces, why does silver move so much more dramatically than gold? The answer comes down to liquidity and demand structure. Gold is primarily a financial asset. Central banks hold it. Large institutions invest in it. Global reserves include it. Silver, on the other hand, has a larger industrial demand component. This means economic cycles can have a bigger impact on silver prices. If manufacturing activity rises, silver demand increases. If industrial activity slows, silver demand may decline. So silver reacts to both economic growth and financial fear. That dual nature makes the metal uniquely volatile. And here's something that surprises many investors. Despite all this volatility, silver has historically experienced some of the most explosive price rallies in commodity markets. During certain cycles, silver has dramatically outperformed gold, which is why traders and investors watch the metal so closely during periods of geopolitical stress, supply constraints. Supply dynamics are also an important part of the silver story. Unlike gold, which is often mined specifically for investment demand, most silver is produced as a byproduct of mining other metals. Silver production is often tied to copper mining, lead and zinc mining, gold mining. That means silver supply doesn't always respond quickly to changes in demand. If demand rises suddenly, supply may take years to adjust. This imbalance can amplify price swings. According to data from the Silver Institute, global silver markets have faced supply deficits in recent years. In other words, more silver has been consumed than produced. That kind of structural imbalance can create powerful market moves when demand accelerates. The safe haven narrative. During periods of geopolitical tension, investors often shift money toward assets perceived as safe. Historically, those assets include gold, government bonds, the US dollar. But in recent years, precious metals have regained attention as traditional safe havens. Central banks themselves have been accumulating gold reserves at record levels. According to the World Gold Council, central bank gold purchases have been among the highest in decades. And while central banks rarely buy silver directly, rising interest in precious metals tends to benefit the entire sector. And silver often follows gold's trend, sometimes in exaggerated fashion. Another major force supporting silver demand comes from the global energy transition. Solar energy systems require large quantities of silver for electrical conductivity. Every solar panel contains small amounts of the metal. But when millions of panels are produced each year, the total demand becomes enormous. As countries expand renewable energy capacity, silver consumption could continue increasing. This creates a fascinating dynamic. Silver isn't just a hedge against uncertainty. It's also tied to long-term technological growth. Few commodities have this dual demand structure. So let's pause for a moment. Because when you combine everything we've discussed so far, the silver market begins to look very different. You have rising geopolitical tensions, uncertain interest rate policy, volatile energy prices, expanding industrial demand, and structural supply challenges. That's a powerful combination. And when markets try to price all of those forces at once, volatility becomes inevitable. So what should investors pay attention to now? First, energy markets. If oil prices continue rising due to geopolitical tensions, inflation expectations may climb again. Second, central bank policy. If the Federal Reserve begins signaling rate cuts, the US dollar could weaken, which would typically support precious metals. Third, industrial demand trends. Strong global manufacturing activity could increase silver consumption. And fourth, geopolitical developments themselves. Markets respond quickly to changes in global risk. Even small developments can trigger major price reactions. So is this volatility signaling a coming crash or breakout? The honest answer is that volatility itself doesn't predict direction, but it often appears before major moves. When markets transition from calm to unstable conditions, prices are usually searching for a new equilibrium. That equilibrium could be higher or lower. But history shows that silver rarely stays quiet for long. Silver's current volatility is not happening in isolation. It reflects a world facing multiple uncertainties at once. Geopolitical tensions, energy market instability, monetary policy shifts, technological transformation, and global economic adjustments. All of these forces intersect in the silver market. And when they do, price movements can become dramatic. For investors, the key is understanding why those movements happen. Because volatility without context can feel chaotic, but volatility with context becomes information. And right now, the silver market is telling us that the global financial system is navigating a complex and rapidly changing environment. Whether silver ultimately breaks higher or experiences further pullbacks, one thing is certain. This metal will remain one of the most closely watched indicators of global economic stress. So keep watching the data, watch the energy markets, watch central bank policy, and most importantly, watch the volatility. Because in markets like silver, volatility is often the first signal that something big